All right, so here's what we're going to talk about tonight. We're going to go over some of the reference materials. We'll talk about some notable income tax changes, the personal income tax form, the NJ 1040. We're kind of going to go through traditionally what we went through, the sections of the form, how they're completed. Most of this stuff, most of you already know. So it's just a very brief review. We're just going to touch on some common areas that you encounter. Again, in our previous presentation, we had a property tax relief program section that covered anchor and senior freeze. Tonight, for the sake of time, we're not really going to go over anchor at all. And we're really going to stick with senior freeze because there's been a lot of very positive changes to the senior freeze program, which I know Jim is just chomping at the bit to talk to you about. Right, Jim? You're just super excited. You can't wait to talk about that.
Of course.
And then we will end with talking about some resources for you where you can go to get help for you or your clients if you need it. So the reference materials, one of the greatest reference materials I think that we have is the letter that is in the instruction booklet for the NJ 1040, because I think that letter really gives a good summary of some of the major changes that have happened to the NJ 1040 for the year. You'll notice here in this letter, they talk about the changes to the child tax credit. It has increased. We're going to talk a little bit about that. You'll also see that there is something called the NJEZ enroll form. I know we have been getting a lot of emails from you with questions about that EZ enroll form, as far as whether it's going to be in TaxSlayer, how you're going to submit that form to us. It should be in TaxSlayer. So to answer that question, it should be part of the TaxSlayer package. You should be able to just simply upload that as part of the package for the income tax return. If you can't, we'll deal with that afterwards, but we're thinking it should be part of the TaxSlayer package. So just to get that out of the way, but we have been getting emails with that question. You'll notice we also have a new acting director, and that is Marita Scarata. She is a 40-year plus Division of Taxation employee. She has been with us a long time, and we are excited to be under her leadership. So yeah, we're excited for what the future holds for the Division of Taxation. She is a passionate, dedicated state employee, and yeah, so we think the future is bright. So the NJ 1040, the booklet looks the same every year. Here are some of the key changes that you'll see. The child tax credit, we're going to talk about that. The excess UIWF, SWF, DIFLI, we're going to talk about that. In particular, the disability, excess disability. Bottom line, there is none. We're going to explain that in a little bit for you. The convenience of the employer rule, what is that? We'll talk a little bit about that. I'm sorry about this. I don't know who that is. Potential spam. Of course, they're going to call when I'm doing a presentation. And the New Jersey Easy Enrollment Health Insurance Program, we'll talk about that. Also, the worksheets, we have these all together for you in an easy packet. The worksheets, all the worksheets. Did you guys get this in an email, by the way? If you didn't, I have to make sure that we get it out to you, where we have it all together for you in an email with all the worksheets. Like, I don't know if we sent that. I hope we did. If we didn't, I'll make sure that we get that out to you. So let's talk some notable income tax changes. The filing deadline is April the 15th this year. I know last year it was April the 18th due to the, I think it's Emancipation Day, which is a federal holiday. So the federal deadline was extended, and likewise was New Jersey's deadline. But this year we're back to April the 15th. The filing options that are available for the New Jersey return is e-file. You can do the New Jersey online income tax filing, or you can do the traditional paper filing. We begin issuing refunds in March. And again, we delayed the issuing of the refunds until March to allow us time to receive the data from employers. We are waiting on the W-2 data from the employer side of things, which doesn't come to us till the end of February, so that we can do data matching to ensure the accuracy of the information on the tax return with the information that's being reported to us from the employer. So once we're able to do that data matching, then we are able to approve the refunds. The child tax credit, again, it's doubling up. So it's double of what it was the last year. The eligibility requirements, however, are the same. It remains a refundable credit. It is for New Jersey resident taxpayers who have a taxable income of $80,000 or less, and they are claiming a child as a dependent on the return that is age 5 or younger. So when we say doubling up, what does that mean? Well, for taxpayers with income of $30,000 or less, last year their credit was $500. This year their credit is going to be $1,000. Likewise, someone whose income fell in that $30,001 to $40,000, their credit last year was $400. This year is going to be $800. And as you can see, so on and so forth, as the income increases, the credit decreases. Either way, it's going to be double what they received the year before. Now, this is a notable change. And I don't know how many of you, whether or not this is the type of return you do, but I think some of you do returns where you have the credit for taxes paid to other jurisdictions. So if you are doing a tax return where you are completing the credit for taxes paid to other jurisdictions, you may be aware of something where in the past, if the taxpayer claimed the credit for taxes paid to other jurisdictions, and then the state that they worked in came back to them years later and said, you know what, you did that non-resident return wrong. And in actuality, you owe us more tax. They would come to us and say, hey, I know it's 4 years later, but this state just notified me and let me know that I owe them more tax. So that now means that I have to file an amended return with New Jersey. What does that mean as far as your statute of limitations? Well, our guidelines were always this. So in our GIT 3B or 3W, which is our online publication that gives guidance on this, it always said this when it came to that. If an audit results in an overpayment, the taxpayer, the taxpayer can request a refund regardless of any otherwise applicable statute of limitations, provided you claim the credit for the state or municipality on your original return. And that's basically what the law says. So the law would say, okay, if this happened to you, the other state has audited you, now you owe them more money, which means now you have to adjust your credit and you're probably going to be due a refund from New Jersey. We're going to ignore the statute of limitations, basically is what we're saying. Your original statute of limitations doesn't apply here. But we really didn't give anything more definitive than that. So what does that mean? Does that mean that you can now send us something you can apply for a refund 10 years later, 20 years later, 30 years later? What does that mean? Well, now, effective January 1, 2023, we've now put a time limit on it. So now we're saying when this happens and you apply for this credit and there is an adjustment by the other jurisdiction, they now have either the original statute of limitations. So the original statute of limitations says you have 3 years. That's the normal. 3 years from the due date of the return or 2 years from the time the tax was paid. So that's the normal. That's your normal everyday statute of limitations. Or they have to notify us within 1 year that they were notified of the change by the other state. Okay, so now we put a time frame on it. So over here, it was vague. It just said, just go ahead and request the refund regardless of any applicable statute. So we didn't give a time frame. Now we're putting a time limit. We say, okay, you're either going to follow the original statute or it's going to be within a year of the time you were notified of the additional tax that was due by the other jurisdiction, whichever one is later. So I hope everybody understands that. So we're putting, bottom line is, we're putting a time frame on it now. Disability insurance, and I kind of gave you a clue on this one. So when it comes to disability insurance, you might have noticed, if any of you are still working as an employee, you may have noticed over this past year that you did not have contributions coming out of your paycheck into the disability insurance fund. Nobody had them coming out. So because you had no disability insurance contributions coming out of your paycheck this year, no one is going to have excessive disability insurance contributions that they can claim on their New Jersey tax return for 2023. By the way, I did check my pay stub for the first one for 2024, and it looks like we're not having any contributions coming out for 2024 as well, just to let you know. Another question, and you guys have sent this question into me. As a matter of fact, Colleen, I can always count on Colleen for questions. So thank you, Colleen. And Colleen has sent me this question when it comes to the pilot program. And many of you, if you're dealing with clients when it comes to Anchor, and especially renters, you know that we changed our position as it relates to Anchor and renters and pilot. And so as a renter, if you are renting a unit in a building that is subject to pilot, you are now eligible for Anchor. Previously, under Homestead, you were not eligible for the Homestead benefit, but you are now eligible for Anchor. So those renters who rent a unit in a building that's subject to pilot get Anchor. So then the question came to me is like, well, if they're getting Anchor, can they get the $50 property tax credit? And the answer to that is no. And I just got clarification and on that to make sure that that is correct. And the answer is no, there are two separate laws. So pilot still remains ineligible for a property tax deduction or credit. So I just want to make sure that everyone is clear on that. So when it comes to the pilot program, and remember, the pilot program is a program that allows municipalities to exempt developers from full property taxes, not only developers, but property owners, in an effort to refurbish or to improve existing structures within that municipality. They're basically giving a property tax discount or some type of incentive so that properties can be refurbished, redeveloped in their municipality. So because they're already getting a property tax benefit within that municipality, they're not eligible for property tax deduction or a property tax credit on the New Jersey tax return, regardless of whether it's a homeowner or a renter. It doesn't matter. They're not eligible. Okay. All right, so those are the highlights. Now let's just get into the form a little bit, because I don't want to take up too much time. I want to make sure that Jim has plenty of time to share his good news, right, Jim?
Oh, yes. Yes, there is plenty of it.
Yes, plenty of good news when it comes to senior freeze. So let's talk exemption versus filing status. And like I said, many of you, I've talked to you year after year after year. So many of you are very aware of this. But just as reminders, domestic partnerships, civil union couples, same-sex marriage. What are the differences between all three of these? So the domestic partnership, the domestic partner is merely an exemption. It is not a filing status. So someone who has a domestic partner may be able to claim an exemption on the tax return for that domestic partner, as long as that domestic partner is not required to file a tax return because their income is too low, And as long as they've entered into that domestic partnership, they met the guidelines to enter into that domestic partnership at the municipal level. So they have to have a certificate of domestic partnership that they entered into at the municipal level. Okay. And they have to meet certain guidelines to qualify to do that. But again, it is not considered married. And so it is not considered a filing status. A civil union couple is considered or has the same rights as a married couple and is treated as married under New Jersey law. So a civil union couple is must choose or select one of the filing statuses of married in New Jersey, whether it be married filing joint or married filing separately, unless they meet the qualifications to file as head of household, such as being separated the last 6 months of the year and having a dependent that they are taking care of those last 6 months of the year. So other than that, they're going to be married filing joint or married filing separately. Same-sex marriage is exactly that. They're either married filing joint or married filing separately, unless they meet that special condition where they can be considered head of household. So civil union couples, same-sex marriage are considered married filing statuses under New Jersey law, and they're either choosing joint or separate, depending on their preference, unless they meet the special condition to be considered head of household. The veteran exemption. This is, I guess, is still relatively new. It's been around maybe like 5 years, maybe, I think. The veteran exemption, it increased to $6,000. It is a personal exemption. The qualifications are that you had to be honorably discharged or released from military service in the reserves or the National Guard. And you basically have to certify. And most people have certified at this point, but if they have not, they need to provide documentation, which for most people is the DD 214. If they don't have that, there is other documentation that they can provide. We have a whole list of other documentation that we would deem acceptable that is available on our website. They can pre-certify or ahead of time, or they can certify after they file. How they do that is they go online, they upload their documentation on New Jersey Honors. They can mail the documentation to us, they can fax it to us. In addition to sending us the documentation, there is a submission form that is available online that they should complete as well. So they do the submission form, they submit their proof, which is usually the DD 214 for most, and they send that to us. We note their account that they are indeed, that they are qualified for the exemption. That stays on the account, and they get the exemption from then on. There is no longer questioned. They only need to do this one time. All right, so that's all of page 1. We're already done. And we move right on to page 2. So once we get to page 2 of the return, this is where on page 2, they start telling us what type of income they have. But on page 2 of the return, one of the things that we say is we don't want to know about all of your income. And in particular, we don't want to know about the income that is tax exempt. Tax exempt income, we tell you we don't want reported at all on the return, with the exception of one type of income, and that is tax exempt interest. All other income, we say, don't even report it on the return. We don't want to see it. We have this whole nice long list. I believe it's on page 8, and it says it down here at the bottom of the slide. Page 8 of the NJ 1040, we have this long list of all these different types of income that is not considered taxable income in New Jersey. And I always say, because everybody thinks New Jersey taxes everything. New Jersey is the taxing state. New Jersey taxes everything. Blah, 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 blah. Well, I am a Jersey girl, and I always say, well, there's a lot of things we don't tax, guys. And I always show you guys, wait a minute. You know what? I brought the form home. Yes, I did. And I always show you guys the list because I always try to tell you guys how great New Jersey is. And so then I always say, I'm going to show you guys a list of taxable income versus tax exempt income. Oh, here it is. Yeah. So I don't know if you guys can see it. So, Tim, can they see it?
You can see a list, but you can't really read what it says.
All right. Can you see how long the list is, Jim?
It's pretty long, yeah.
Yeah, you see that, you see the yellow there that says examples of non-taxable income. You see that yellow highlight there?
I can see where you're pointing. I can't see clearly enough for the yellow, but
All right, Jim, you're supposed to be siding with me here, Jim. All right, so Jim, like, can you see how long this list is here, Jim? See how
yes,
long this list is?
it is a
Yeah, and
very
it's
long
not,
list.
it's very, very long, right? See, Jim, it's not
Yes.
even done yet. See, it goes all the way over to the other side of the paper, right? All the way over here. See, look. Boom, boom. These are all the things that we don't tax people. See? And then our list of a taxable income is a lot less. It's not even a full side of the paper. So I just wanted to show you guys this because I brought it home. So anyway, I'm saying all of this to say there's a lot of things in New Jersey that we don't tax. While there are a lot of things we do tax, there's a lot we don't. So, for instance, we don't tax Social Security. We don't tax unemployment. We don't tax cancellation of debt. We don't tax military pension. We don't tax family leave insurance benefits, and so on and so on and so on. So there's a lot we don't tax, and the items we don't tax, we don't want to see anywhere on the return. Wages, we went over this every year where we want to see the wages come from. And I think you guys already know, and most of you use software, so your software already knows where to pull the wages from, but it's from the bottom of the return, the state wage box figure from box 16 of the W-2, not box 1, which is the federal wage figure. But again, I know you guys are already very familiar with this. So it's down at the bottom of the return. Those are where the state figures are. Tax exempt interest. Again, this is where we do require you to report this on line 16B, but again, we're not taxing it, but we do require it to be reported. And one of the things in one of, I think our face-to-face session that we had, someone reminded me of our publication that we have, our GIT, I think it's the GIT 5. If you ever are not sure whether or not a certain type of interest that someone has is taxable, take a look at that publication. It is excellent. It goes through all the different types of, a lot of different types, probably not all, but there's a lot of different types of investments people can have, and it lists different ones, and it has simply a T or an E. If it's T, it's taxable. If it's E, it's exempt. And you can very clearly see which types of investments would be taxable and which ones are exempt in New Jersey. So if you're ever questioning it, the first place to go would be this publication and check there first. All right, pension, annuity, and IRA income. So 2 different types of plans, and the one I call the dinosaur is the non-contributory because I just don't think you really see them anymore. This was back in the day when I first started working, where your employer just paid it in for you. You didn't have to contribute anything. The employer did it all for you. So that's fully taxable. The contributory one is where you put money in, your employer puts money in, maybe, maybe not. And then there's interest. Those are partially taxable. So I'll kind of break it down a little further for you. The non-contributory plan, the employer, when he's putting money in, we're not taxing it. When the earnings are going in, it's not being taxed. Therefore, when you take money out, none of it has been taxed. So it's 100% taxable. There's no fancy calculations you have to do. This type of plan is easy once you retire. None of it's been taxed. Therefore, whatever you were taking out at retirement, 100% taxable, you don't have to worry about it. You get $10,000 a year, it's $10,000 a year that's taxable. You don't need to worry about trying to figure anything out. The contributory plan, though, was a little different because although the employer contributions weren't taxed, when the employer is putting his contributions in, those contributions haven't been taxed yet. The earnings haven't been taxed yet. But the employees' contributions while they were working have been. In New Jersey, when you contribute into your pension plan, your contributions while you are working are being taxed with the exception of one plan, and we'll talk about that. But all other plans, we are taxing your contributions while you're working. So what that means is when you retire and begin to take a distribution or withdrawal from that plan, it is not 100% taxable because you've already paid some of the tax. What that means is now you've got to do a calculation to figure out what portion of what you're receiving each year is taxable. In New Jersey, unlike the federal government, we don't have a simplified calculation method, which means that our calculation varies from the federal treatment. So we have two different ways that we calculate it. There's the 3-year rule. Taxpayers are eligible to use the 3-year rule if the employees' contributions that they paid in, that their previously taxed contributions, can be recovered within 36 months after they retire, and both they, the employee, and the employer contributed to the plan. Then, if that's the case, they can use the 3-year rule. And what that means is that the pension income is not taxable until the employee has fully recovered their contributions. Once they fully recover their contributions, now it is 100% taxable from that point on moving forward. So no fancy calculations really, just initially. So if it looks like they're going to fully recover their contributions in 30 months, then that means the first 30 months, they don't have to report anything. It's not taxable. Then month 31, moving forward, 100% taxable, and they just report what they receive every month, every year, whatever they receive from that point on, and it's 100% taxable from that point on. Now, the general rule, unlike the 3-year rule, is usually used by people who don't qualify to use the 3-year rule. So those are people who won't be able to fully recover their contributions within a 36-month period. So the 3-year rule determines what portion of what they're receiving is excludable. So those are the previously taxed employee contributions, and what portion of what they're receiving annually is taxable. So that represents their employer's contributions and the earnings on the account. So that's what they've got to calculate out of each year's distribution. They're going to use Worksheet B to do that. They use Worksheet B just in year 1. They're going to use Worksheet B. They're going to calculate. They're going to take the overall, what they expect they're going to receive over the lifetime of the overall value of that pension plan, what their annual distribution is, how much they've paid into it, and they're going to come up with a percentage that represents the previously taxed portion of the plan, and they're going to apply that to their annual distribution. Once they come up with that percentage, they're going to use that same percentage every year. They don't need to do any recalculation. They're going to use the same percentage. The only time they need to recalculate is if the annual distribution amount decreases. Then they need to recalculate. Okay? All right. So, quick thing to remember when it comes to pension calculation. You can't help anybody with a pension calculation if they don't have their records. They must have their records. They must know how much their contributions were, what their previously taxed contributions were. If they don't have their records, they don't know, then it's 100% taxable. And I would hate for somebody to pay tax on a portion of their distribution if they don't have to. So it's really important that they keep the statement that the pension administrator gives them at retirement that statement that they give them right after they retire, it's really important that they hold on to that. And if they didn't, they need to contact the administrator to get a replacement. If they recover their contributions within 36 months, they can use either the 3-year rule or the general rule. It's their choice at that point. And you should advise them of their options. If they're not going to be able to recover their contributions within 36 months, then they don't have a choice. They're going to have to use the general rule. All right, so this is what the worksheet A looks like. The worksheet A helps them determine whether or not they're even eligible for the 3-year rule, and whether or not they need to use the general rule. So that'll help them figure that out. Worksheet B, then once they figure out that they can't use the the 3-year rule, it tells them to continue on with worksheet B, which helps them determine their percentage. Now, when it comes to IRAs, they're going to use worksheet C. So worksheet C is used to figure out an IRA. Now, when it comes to an IRA or using worksheet C, if you have a client that has multiple IRAs, they can use one worksheet C and just combine all the IRAs on one, or they can use a separate worksheet C for each different account. It's really up to them. When it comes to Roth distributions, remember that a Roth distribution is exempt as long as it's qualified. So to be qualified, it has to meet certain conditions. One condition is that the money has to be in the account untouched for 5 years, and then it has to be taken out for one of 4 reasons. One of those reasons is either the person has reached age 59 and a half. So that's reason 1. Reason 2, they have become disabled. Reason 3 is the person has died, I believe. And so now the money is being passed on to beneficiaries. And reason 4 is they have taken the money out to buy a home, first-time home buyer. So I think those are the reasons. There might be one more that I'm missing, I'm not sure. But those are reasons that someone could take it out. So reason number 1, number 1 qualification is that it must sit in the account 5 years and not be touched. That's number 1. After it's sat in there 5 years, it has to meet one of those 4 things I was talking about. If it meets one of the 4 things I was talking about, it can be taken out, is considered qualified, and there is no tax due. If it's taken out and it's not qualified, there is tax due on the portion of it that represents earnings. Cool? Cool, Abra. I hear you guys say. I hear you. All right. So here is the worksheet C. Worksheet C has a part 1, a part 2, a part 3. Part 1 is the calculating that. So in part 1, there's lines 1, 2, and 3 where you calculate the value of the IRA. So what's the value at the end of the year plus the amount that was distributed so that you get the total value of the IRA at any point during the year. Then you figure out what the unrecovered contributions were. And you do part 2 if it's the second year or later. And part 3 is if somebody hasn't filled out a worksheet before and they really should have. And so now you've got to figure out what the unrecovered portion was. All of this, we're not going to go through all of this and how to fill it out. But if you have questions, you can always reach out to the division and we can walk it through with you. Again, quick tips here. If your client doesn't have their records, there is nothing to exclude. There is no calculation to figure out. There is no worksheet C to complete. They don't have their record of their contributions. It's 100% taxable. They have nothing to prove that they ever paid tax on any of the money. Therefore, it's 100% taxable. So it's really important that taxpayers, your clients, keep good records so that they don't run into this issue in the future. All right, so we were talking all about the pension income, but we did not really get into Section 401k. So remember I said when it comes to contributory plans in New Jersey, I was saying that when you're contributing into your plan, New Jersey is taxing those contributions while you're working. And I said there was one exception. This is that exception. When it comes to 401k plans, your contributions to those plans are not taxed in New Jersey. And that happened as of January 1, 1984. So any contributions made on or after January 1, 1984 are no longer subject to tax in New Jersey unless your contributions exceed the federal limits. So any contributions that exceed the federal limits will be taxed, but for most taxpayers, that does not happen. So we are not taxing your contributions to a 401k. The only taxpayer that will have tax paid on their contributions to a 401k are either taxpayers who made contributions prior to January 1, 1984, which are few and far between at this point, or taxpayers who made any contributions that exceeded the federal limit for the year, which I think, again, are few and far between. So what does that mean? That means that anybody who gets a distribution from a 401k, their distribution is 100% taxable because we've taxed none of the money at this point. We didn't tax the employer's contributions to the plan. We did not tax any earnings to the plan, and we did not tax the employee's contributions to the plan. Therefore, it's 100% taxable unless these two conditions here are met. All right. All right. Bottom line, once you get done with all these fancy calculations, you've done worksheet A, you've done worksheet B, you've done worksheet C, what you end up with is a taxable portion that goes on line 20A. So line 20A is the taxable portion you have calculated after you've done your general rule, after you've done your worksheet C. That's your taxable portion. Your 20B are the portion of your calculations that you are excluding. These represent the excludable portions. It does not represent the exempt pension income. So I want to make sure that that's clear. It does not represent exempt pension income. When I mean by exempt pension income, it does not represent a disability pension, which again, it's on that exempt list, which means it shouldn't be on the return at all. It does not represent military pension, which again is on this exempt list, this long list that I was talking about. So since it's not, if it's on this long list, it should not be on this return at all. So if it's here, it doesn't go here. What goes here on line 20B is anything that's on worksheet, is on your worksheet A, B, or C that you've excluded from your calculations. That goes on line 20B. So it's the portion of your calculation that represents your previously taxed contributions to the plans. Cool? So your line 20A, your line 20B, when you add them together, should equal the total retirement income distribution that's reported on your 1099-R. That's what it should turn out to be. The reason that we added those lines was to prevent us, to help us to not send people bills that we really shouldn't be sending them. We didn't want to send you bills that say, hey, on your federal return, we noticed that you reported pension income, but on your New Jersey return, you didn't report pension income. So we think you made a mistake, and we think you owe New Jersey tax. When in actuality, you don't, because you were using the 3-year rule, but we didn't know that, and so we just thought you made a mistake. We added this line here so that we could clearly see, oh, they didn't report anything on line 20A, but on line 20B, we see, oh, there's the pension income. Oh, they must be using the 3-year rule. Now it makes sense. Yeah, we see that same amount on the federal return, but oh, we also see it here on line 20B. Oh, they're using the 3-year rule. It makes sense. Don't send them the notice. That's the whole reason we did it. Make sense? Hopefully. Hopefully it makes sense. See, I'm trying to point out to you that we are the good guys. Is it working? All right, maybe not, but I'm trying. All right, so let's talk gambling winnings. So gambling winnings, we all, well, hopefully most of us know what gambling winnings are. Remember that New Jersey lottery winnings are only taxable if the single prize amount is over $10,000. Anything less than that for a single prize amount is not taxable and should not be reported on the New Jersey return. All out-of-state lottery winnings, however, are taxable and should be reported regardless of amount. And you can and should be deducting any losses against the winnings. And we always encourage taxpayers to really keep good. Somebody who is a gambler really should be keeping good records of their losses, and they need to have proof of those losses. So people who are really gamblers and do this on a regular basis are pretty good at keeping records. I must admit, I think too, casinos are really good about keeping records on behalf of taxpayers. So there should be some kind of daily log, a journal, canceled checks, losing lottery tickets, losing racetrack tickets, whatever they have, but they really need to have good records so that in case they're ever audited, they're able to substantiate the losses that they're claiming on the return. They net their losses and their wins, and they report the net on the return. All righty. And the way that I've always told people is it needs to make sense. If we're going to audit you, probably if we're auditing you, it's because it doesn't look right. It doesn't make sense. I mean, if you have lottery winnings, if it shows that you have $1 million of lottery winnings, we have a W-2G that says that you have $1 million of lottery winnings, and you were able to bring it all the way down to like $20,000 from $1 million, all the way down to $20,000 because you say you have gambling losses. We're going to want you to substantiate that. And you're probably going to get some sort of audit that says, hey, we want you to substantiate how you were able to write off $980,000, So that's what we mean. You're going to have to be able to substantiate, especially if it's massive losses like that. We're probably going to look for some sort of documentation to prove that. All right. Retirement and pension exclusion effective tax year 2021, New Jersey total income limit went up to $150,000. And I remember coming out and talking to you guys year after year, and you guys kind of beat me up a bit for a long time about that $100,000 income threshold that we had. And yeah, I hated it too. So we had the pension exclusion that had $100,000 limit, and then we made the income qualification $100,000, and so that didn't make a lot of sense. So finally, we changed it, and we upped the income limit to $150,000, and the qualifications remain 62 years of age or older or disabled for the pension exclusion. So if your income is $0 to $100,000, not much has changed here. You still have the flat amount, married filing joints. You can exclude up to $100,000 of pension income. If you are single, $75,000. If you are married filing separate, $50,000. Head of household qualifying widow, $75,000. And then you'll see its percentages if your income is over $100,000. So it depends on where you fall. You get to exclude a percentage of the pension income. And then likewise, and then I love how we have it in the book. I think it makes it pretty easy. So in the book, in the instruction booklet, it tells them, okay, report the amount from line 20A, put that right here. And then it tells them to use the chart and put the amount from the chart. And then it tells them to take the lesser. So if your amount on line 20A, if I am married filing joint and my amount in line 20A is 50,000, and then it says take the amount from B from the chart, and I go down here, it's married filing joint, it says 100,000, then it says take the lesser. So I'm going to put 50,000 on line 28A. So although I'm entitled to 100,000, since 50,000 is all I have on line 20A, that's what I'm going to take on line 28A. So I think it's pretty clear in the tax booklet. But then, if I didn't use all of my pension exclusion, and in that simple example I just gave, I wouldn't have used my whole 100,000, I only used half of it, then I might be able to use the rest of it on my other income. But in order to do that, I have to be age 62 or older, not disabled. That's not a qualification. It's only age 62 or older. And my earned income, which is wages, net profits from business, S corp income, partnership income, has to be $3,000 or less. If I meet that qualification, then I may be able to exclude the other income on my return. So for that, I've got to do the worksheet D. Now you notice for worksheet D, they have this box down here at the bottom. So on the box down here at the bottom, it has this chart here. But notice here, if my income falls between 100,000 and 150,000, I'm still getting a percentage. So on the previous chart, I was getting a percentage of the pension income, but on this chart, I'm getting a percentage of my overall income. Okay, so on the first chart, I get if I'm in this category, I'm getting a percentage of my pension income, and then my other retirement income exclusion is a percentage of my overall income. So what happens if I fall in this category? I'm subtracting out what I already used of my overall income and the pension portion, and whatever's left, I might be able to deduct against my other income. Sounds a little confusing, but when you start working through the numbers, it's not really that bad. And you guys all have software that probably does it automatically for you, but I just wanted to kind of bring it to your awareness. Bottom line is, once you're done all of that, we're at the gross income portion. Once you hit this portion, if the income is $10,000 or less for those that are single or married filing separately, there is no filing requirement. If the income is $20,000 or less for those that are married filing joint, head of household, or qualifying widower, there is no filing requirement. But they might want to file, and they may want to file if they have a refundable credit that they're due, if they made estimated payments, if they have withholdings that they need to get back. So those are reasons someone may still want to file even if they don't have to file. So let's talk about some of the deductions on the return. One of the main deductions that your client may be eligible for that they might not necessarily be eligible for on the federal return is the medical expense deduction. Because the medical expense deduction is much harder to get on the federal return, they might not get it on the federal side, but they can get it on the New Jersey return because it is only, they only have to have medical expenses that exceed 2% of the gross income in order to qualify. So once they have medical expenses that exceed 2% of the gross income, they are able to deduct that off of their New Jersey gross income, thus reducing their tax. The property tax deduction, we up this as well. This was $10,000 just a couple of years ago. We have upped it now to $15,000, thankfully, since a lot of people in New Jersey pay property taxes that unfortunately even exceed $15,000. So I'm glad that we have increased the property tax deduction to $15,000. Married filing separately, living in the same household, it is $7,500 per spouse. The property tax credit or deduction, they're going to enter the property taxes on line 40A. Homestead benefit applicants should include any credit amount that they might have received. PTR applicants, if you have someone that's a senior freeze applicant filing a PTR application, they really should be using the base year amount when they are calculating the property tax deduction or credit, because they are receiving a reimbursement check for a portion of their property taxes. So they really are only supposed to be using the base year amount when they're calculating this on their tax return. And let's see. So they're going to use worksheet H to calculate which one is the greater benefit. And they're either going to enter the property tax amount on line 40, or they're going to take the $50 credit on line 56, whichever one provides the greater benefit. And now we're really at the end at this point, and it's just calculating the tax. If you have someone that is working out of state and paying tax to another jurisdiction, they can certainly calculate the credit for taxes paid to other jurisdictions by doing the Schedule NJ COJ and taking that credit. Usually this credit is based on the percentage of income that is earned in the other jurisdiction. And it's usually a percentage credit. So the credit is based on if the percentage of income is 40% in the other jurisdiction, then the credit would be 40% of the tax. Usually is how it works out, not always, but usually. Use tax, this is always a fun topic. But if you have a taxpayer who makes purchases outside of New Jersey and other states, mail order purchases, makes purchases online, and they don't pay New Jersey sales tax, but they are using the product in New Jersey, they really are supposed to pay something called use tax for using the product in our beautiful garden state. So if that occurs and they are making those type of purchases, they can certainly fulfill their use tax obligation by paying the use tax when they file their New Jersey tax return. And if they're not really sure how much they owe, they can certainly fill in the handy dandy schedule that we put on the tax return. That's Schedule K, and they can fill in the chart and we can tell them based on their income what we think they might owe. And they can certainly enclose a check for it and we will happily take it. So, the use tax is going to be 6.625% if they did not pay sales tax in the state that they made the purchase. So for instance, if they went to Delaware and made a purchase of an item and brought it back into New Jersey for use, then they're going to pay 6.625%. If they paid a lower tax rate, like went to Virginia, say, and paid 5%, brought it back into New Jersey for use, then they're going to pay 1.625% of sales tax, use tax in New Jersey for the difference between the 5% and the 6.625%. Right. Ooh, shared responsibility payment. This is also a very popular topic. So New Jersey instituted the shared responsibility payment, I think it was about 3 years ago, 3 years ago. But basically, New Jersey law requires now that all New Jersey residents have health insurance coverage, or they must qualify for an exemption. If they don't qualify for an exemption and they don't have health coverage, then they're going to be required to pay a shared responsibility payment. They're not required to make this payment if they're below the filing threshold, if they can be claimed as a dependent on someone else's return, if they had minimum essential coverage for the year, or they meet some sort of exemption. So this was kind of the general gist to this. However, this year there has been a change. This year, to make it easier for people who don't have health coverage, we are offering something called the Health Insurance Easy Enroll form. And this easy enroll form is available now to individuals. So if you have a tax household where if you or someone in your tax household doesn't have this essential minimum essential coverage, all you have to do is complete this easy enroll form, basically asking the Get Covered New Jersey to help you obtain coverage. So completing this form is basically asking them to look at the information from your tax return and see what you qualify for. Then they email you what coverage is available to you, how much is going to cost. You respond to that email and you basically get the ball rolling. As long as they respond to that email, they should be fine, and it waives the shared responsibility payment. So I think it's really, really good, and it makes it easier for people. I was discussing this with my team recently, and I was saying that for a lot of people who don't have health insurance, a lot of them are poor, and the thought of trying to put food on the table, just keep their bills paid, keep a roof over their head, and then trying to like figure out like insurance and trying to fill out these forms and trying to all the coverages and trying to figure it all out, it's overwhelming. And I've helped my kids try to do this when they came off of my coverage. The whole thing is just overwhelming. So I can't imagine trying to do this. So I think this is a really, really, really good program for people. And I think I'm so happy that we're offering this for them. So here's what the form looks like. Now, we do not have this form in our NJ 1040 packet. It is also not part of the NJ 1040 form, but it is on our website. So if you go on our website and you pull up NJ, the income tax forms, it's listed under the NJ 1040. So you'll see the form. So it's very simple, just 1, 2, 3, and they list their website address, and then it says that we send them the email results, and everything is there for them to then take it from there. So they just need to like keep a lookout on their email so that they can get the information, and then it's up to the taxpayer to then follow through from there. So I think from that point on, the taxpayer just needs to take the ball and run with it. But I think it's a good way for us to kind of help push the taxpayer along to kind of get the coverage that now New Jersey law says they have to have. It's just us trying to help them along a little bit more. So I think it's a good thing. All right, so the withholdings. All right, I'm trying to stop talking so much, Jim, so I can give you more time. The earned income credit, no changes here. No changes here at all. Remember that we took away the age requirement. So that we took away the 65 or that well, anyway, it's 40% of the federal EIT, the federal EIC, and they have to be eligible may be eligible for the New Jersey EITC without the federal age requirement. So as long as they weren't claimed on someone else's tax return and they met all of the other federal EIC requirements except for the age, and they were at least age 18 on the 31st, and they did not have a qualifying child, they can still qualify for the New Jersey EITC. And qualifications for the Child Independent Care Credit. They had to have paid expenses for the care of one or more qualifying individuals to work or actively seek work. And the New Jersey taxable income limit is $150,000. And the credit calculation is a percentage of the gross income, is a percentage of the percentage of the federal credit based on the New Jersey taxable income. Someone can qualify for all three. So we're going to have some taxpayers that get the EITC, the New Jersey Child Independent Care Credit, plus the New Jersey Child Tax Credit. In the end, taxpayer is going to figure out whether they're overpaid or underpaid. So they're either going to end up with a refund or end up with tax due. If they end up with a refund, they really need to let us know what to do with the money. Do they want a refund? Do they want to credit it to the next year? Do they want to donate it to a charity? They need to let us know, because if they don't let us know, the money just sits on the account because we don't know what to do with it unless they tell us. Part year residents, keep in mind, if you're dealing with a part year resident, they may need to do 2 returns. If they have income from New Jersey for the entire year, they need to do a non-resident return as well as a resident return for both periods. They also need to prorate everything based on the period of residency versus non-residency, and prorate everything that includes deductions and exemptions. 15 days or more in a month equals a month. And that is it for me. And I talked a lot, and I'm sorry, Jim. Jim, did you want to share yours? Did you want to share your screen, or you want me to just go ahead and click for you?
I can share my screen.
Okay.
Just give me 1 second to get it set up. Okay.
Yep.
All right. So, as Abra said, I'm going to be discussing the property tax reimbursement. In case you forgot, my name is James Birch, by the way. All right. So, We have some important senior freeze program changes for this year. This is effective for the 2023. It was signed into law in June of last year. And it said that beginning with the 2023 filing season, so not for previous years, it begins this year, they are increasing the income limit for the program up to $150,000, and it eliminates the requirement that an applicant must be a New Jersey resident for 10 consecutive years. So these two things mean that a lot more people are going to be eligible than ever before. Right? However, the age and the disability and the 3-year home ownership requirements are remaining unchanged. So you still have to meet, well, actually, let me just go into that slide. You still have to be age 65 or older or receiving a federal Social Security disability as of December 31st, 2022. And you still have to have owned and lived in the home for at least 3 years, which in this case would be December 31st, 2019. Also, property taxes must still be paid in full. In the case of a homeowner, they have to have paid by June 1st of both 2023 and 2024. For a mobile homeowner, it's December 31st of both 2022 and 2023. So those three guidelines are not changing. But here is, in the last bullet point, is something that is changing. A proof of property taxes due and paid. For a homeowner who is filing a PTR2 and they are not part of a co-op or continuing care retirement, they are no longer required to provide proof that they paid their property taxes. Previously, everyone was required to provide that proof. And if you're filing a PTR1, you are still required to. But this year, they made it optional for a homeowner who is filing a PTR2. Now, the division may at some point request that proof be provided, but it is not required when they file. Some more eligibility guidelines are the income limits. As I previously mentioned, they have been increased greatly. For 2022, it's gone up to $150,000 or less. And for 2023, it's a maximum of $163,050. So like I said, many more people than ever before are going to be able to qualify for the PTR. This income limit also is applied regardless of whether they are married or not. Because if you are married or in a civil union, then the income of both spouses are combined together. And we also have a history on our website where you can look and see how the incomes have changed over the years. And you can definitely see there is a huge increase. Previously, they were both in the 90,000s. This is also something that's new for this year. PTR2 filers will be eligible to maintain a base year if their income limit is exceeded. So see, that was signed into law, and it said that a PTR2 applicant whose income exceeds the 2023 income limit can maintain their base year if they meet all other eligibility requirements and they file the 2023 PTR2 application. So they still have to meet the age or the disability requirement. They still have to live and own in a home, own and live in a home for 3 years, and they still have to pay their property taxes. This is only an exception if they pass the income limit, and they are still required to file that application. If they do not file an application, they will be basically kicked out of the program, and they will have to start over again. But that's something that has to be done regardless of whether they exceed the income limit or not. They always have to file each year to remain in the program. Now, if they do exceed that income limit, they're not going to receive a reimbursement because they went over that one guideline. But The reason they would still want to do it anyway is because they will maintain their base year going into 2024. Now, if you're unfamiliar with the base year, that's the first year that someone was eligible for the PTR, and their property taxes are set in our system at that price, that amount. Sorry about that. So normally what happened in previous years, if you exceeded the income, you would not be eligible, and you would have to start all over again, and your base year will be reset at whatever year you are eligible again. And normally that property tax is going to be higher as time goes by. So it is beneficial to maintain that base year when, in most cases, your property taxes were lower. That's not always true, but generally speaking, it is. And this is only a one-time exception. So that if they pass their income limit, the next time they file, they will then have to meet all eligibility requirements, including the income. And these are dates for the new filing deadlines. It is October 31st of 2024, and they can check the status of the reimbursement online on our website. And you can see they're kind of paid, where the earlier someone files, the earlier they will receive the check. Like, for example, on that first line, if they file before May 1st, they should expect to receive a check by July 15th or earlier. And the later they file, the later the checks will be issued. All right, now just as a reminder, for a first-time filer, they always file a Form PTR-1. This establishes their 2022 and 2023 eligibility. It reserves their base year at the 2022 property tax amount, and then if the property taxes increase, they will receive the difference between the 2023 and 2022 property taxes. And you see at the bottom, because this is a PTR-1, they must include proof of property taxes paid. Now, for a second year or later year filer, they do a PTR-2. Now, this is a personalized application. Like a PTR-1, you can go on our website and print out the form. A PTR-2, because it's personalized and it comes pre-printed with someone's base year on it, you cannot print it online. You must contact the division if you have not received one. Sometimes the division does try to send them out, but if for some reason you did not get it, you will need to contact us. This verifies the 2023 eligibility, and they'll receive the difference between the 2023 and whatever year their base year was. Now, I mentioned proof of property taxes several times, and there are different options that can be done to provide that proof. If you are a homeowner, in the booklet there is a form PTR-1A, or if you're a second time or later filer, a PTR-2A. Okay, this is something you would take to your local property tax collector and they can help fill it out. If someone is in a co-op or continuing care facility, they also fill out a form PTR-1A, but a co-op, or a PTR-2A co-op. For mobile homeowners, instead of an A, it's a PTR-B. So PTR-1B or PTR-2B. But there is also a second option that can be done if someone does not get those forms filled out. For a homeowner, they can get a copy of the property tax bill and copies of canceled checks or receipts showing the amount of property taxes paid, or so they can do those first two, or they can do this third one, which is copies of a Form 1098, which they receive from a mortgage company. If someone is in a co-op or continuing care facility, they can get a statement from their management stating their share of property taxes paid for the residential unit. Okay, so a mobile homeowner, they are required to provide a copy of a contract or agreement from a mobile home park, which will show the proof of the amount of the site fees paid. Now, PTR2 application filing options. We have two ways you can do it. You can do it by paper, or this is a fairly new option, so not everyone is aware of it. We can also file online. Both PTR1 and PTR2 applications can be done this way, but they must be on a supported browser. Some examples include Google Chrome, Safari, and Mozilla Firefox. And documents can be uploaded. So if you do need to provide proof, you can upload the documents right on our website. Now, what to do if someone receives the wrong form? If someone was supposed to receive a PTR2, but they received a PTR1 instead, as I said before, you can't print out a PTR2 because it's personalized. So they're going to have to contact the division. They may be asked to provide additional documentation, so they should just be warned that is a possibility. And in most cases, a notice was already sent out by the division letting them know about this, that they may need to provide documentation. Oh, this is a big one. We get this question all the time. People think that they can only do either the anchor or the PTR2. But as long as you meet the eligibility requirements for each program, you can be eligible for both of them. So that's a question I hear all the time. So yes, you can be eligible for both. We have some resources here in case you need additional information after this presentation. I don't know, I'll leave this up here for a moment in case people want to write this down. But we have our main customer service center phone number. They are open from Monday through Friday, 8 a.m. until 4 p.m. And that number is 609 292 6400. We have an anchor number, which is only for anchor calls. So we encourage people not to call that number if it's not an anchor related question, but they are open Monday through Friday, 8:30 a.m. until 5:30 p.m. And that number is 1-888-238-1233. And we have a senior freeze information line, which is the same thing. We try to encourage people only to call that number if it's senior freeze related. Anything else, please call the main customer service center. But the senior freeze line is open Monday through Friday, 8:30 a.m. until 5:30 p.m. And the phone number is 1-800-882-6597. Okay. We also have regional information offices throughout the state. We have them in Camden, Trenton, Freehold, Galloway, Fairlawn, Newark, and Somerville. Now, an appointment is not required, but it is highly recommended that you try to get one if you need to receive office in our information center. And they are open from 9 a.m. until 4 p.m. And anyone who goes there should bring all necessary documents. So whatever it is they're requesting help for, make sure you bring the forms. If it's a death certificate or proof of a payment, whatever the case may be, make sure you bring all the documents so that they can fully help you. Bring some kind of government ID. And if you're representing a taxpayer, you need to have an M5008R. And cash payments are not accepted. That's another question we receive a lot. Where we have options available through social media. We have Facebook, X, which used to be Twitter. We have a YouTube, a LinkedIn, and Instagram. And of course, our main website, which is nj.gov/taxation.